On Tuesday, November 18, 2025, global markets are gripped by a palpable sense of fear and caution. The mood is tense as investors around the world watch their screens, searching for any sign of stability amid the growing uncertainty. Screens flash red as losses ripple from Asia to Europe, reflecting a wave of anxiety, not from a single event, but from a convergence of worries. The sell-off is broad and relentless, with investors struggling to make sense of the rapidly shifting landscape. Investors are pulling back, bracing for turbulence as two major events loom: Nvidia's highly anticipated earnings report and the release of critical U.S. jobs data. Both are seen as pivotal moments that could set the tone for the rest of the year. Every headline and data point is under the microscope, with the potential to trigger sharp market swings. Analysts pore over every detail, searching for clues that might offer a hint of what's to come. The AI boom that fueled recent optimism is now under scrutiny, and doubts about its sustainability are growing. Once the darling of the markets, AI stocks are now facing tough questions about whether their meteoric rise can continue in the face of economic headwinds and shifting investor sentiment. Meanwhile, Japan's economic struggles and a weakening yen add another layer of complexity for global investors. The currency's slide is raising concerns about the health of the world's third-largest economy, and its ripple effects are being felt far beyond Tokyo. The sense is that the era of smooth sailing is ending, replaced by defensive positioning and risk reduction. Investors are no longer chasing returns. They're focused on protecting what they have, shifting strategies to weather the coming storm. The sea of red on trading screens is a physical manifestation of collective anxiety. Traders are trimming risk, reevaluating positions, and preparing for volatility. Across trading floors, the mood is somber and methodical, as professionals brace for whatever surprises the markets may deliver next. The days ahead will test market resilience as corporate earnings, economic data, and policy shifts collide. Every announcement, every press conference, and every data release has the potential to move markets dramatically. Everyone is left wondering which way the winds will blow next. In this climate of uncertainty, caution reigns supreme, and the world waits to see whether the coming days will bring relief or more turbulence. At the center of today's market anxiety stands Nvidia, a company that has rapidly transformed from a niche graphics chipmaker into the undisputed leader of the artificial intelligence revolution. Its influence now stretches far beyond Silicon Valley, reaching into every corner of the global financial markets. Nvidia is now seen as the bellwether for the entire AI sector, with its every move closely watched by investors, analysts, and competitors alike. The company's quarterly earnings have become a litmus test for the health and momentum of the broader technology landscape. Expectations for its earnings are sky high. Investors want proof that massive AI investments are paying off. The stakes are enormous, as Nvidia's results could either validate the billions being poured into AI or raise serious questions about the sector's future. Nvidia's performance is viewed as a verdict on the entire AI ecosystem. Its chips power everything from data centers to self-driving cars, making its success or failure a proxy for the fate of countless other companies. Even a slight miss or a more cautious outlook could send shockwaves through tech stocks and beyond, rattling confidence in the AI boom and potentially dragging down the broader market. The company's meteoric rise has left little room for error, and the pressure to deliver is immense. Every quarter, the bar is set higher, and the margin for disappointment shrinks. This intense focus on a single company exposes a market vulnerability. Too much hope and capital riding on one name. If Nvidia stumbles, the ripple effects could be felt across the entire tech sector and beyond. As the earnings date approaches, tension mounts. A strong report could reignite the bull market, boosting confidence in AI and technology stocks, and perhaps even lifting the entire market. On the other hand, disappointment could trigger a broad sell-off, as investors reassess the risks and rewards of betting so heavily on AI's future. The outcome of Nvidia's earnings will set the tone for investor sentiment well into 2026, shaping decisions on everything from venture capital to public markets. It's a high-stakes moment not just for Nvidia, but for the entire future of AI investing, a pivotal point that could define the next chapter of the technology era. The AI stock rally, led by Nvidia, is drawing comparisons to the dot-com bubble. Valuations are stretched, and some fear optimism is outpacing reality. The key question: is today's investment frenzy sustainable, or are we front-loading decades of growth into current prices? Corporations are pouring billions into AI, but the returns remain uncertain. If productivity gains don't materialize soon, the appetite for AI spending could cool quickly. This could burst the bubble for chipmakers and infrastructure providers. Investors are shifting from euphoria to caution, scrutinizing long-term value. The dot-com bust serves as a warning. Sentiment can turn fast. No one knows if the bubble will pop, but the parallels are making investors nervous. The challenge now is separating real progress from speculative excess. Recent high-profile sales of Nvidia stock by major investors are fueling market anxiety. The sudden moves by these influential players have sent ripples through the financial world, making both institutional and retail investors sit up and take notice. When such large stakeholders decide to cash out, it often signals a shift in sentiment that can't be ignored. Peter Thiel's hedge fund and Japan's SoftBank have both exited their Nvidia positions, raising questions about the stock's future. These are not just any investors. They are considered some of the sharpest minds in finance, with access to deep research and market insights. Their decisions to sell have sparked debates about whether Nvidia's meteoric rise is sustainable or if a correction is looming. These whale moves are closely watched, as they often signal deeper concerns or a belief that valuations have peaked. When the biggest players make a move, it can be a warning sign for others to reassess their own positions. The market tends to interpret these exits as a sign that the easy gains may be over, and that caution is warranted. While reasons for selling vary, the perception is that smart money is heading for the exits. Some may be locking in profits after a historic run, while others could be reacting to broader economic signals or internal risk assessments. Regardless of the motivation, the optics are powerful and can sway market sentiment quickly. This can trigger a domino effect, with smaller investors following suit and increasing selling pressure. As news spreads, fear of missing the chance to sell at the top can lead to a rush for the exits, amplifying volatility and sometimes causing sharp price drops. The actions of Thiel and SoftBank challenge the bullish consensus around Nvidia. Their exits force a re-examination of the company's prospects, especially as it faces growing competition and questions about future growth. Even as analysts remain positive, these exits inject doubt and highlight the risks of overcrowded trades. When too many investors pile into a single stock, the unwinding can be swift and painful if sentiment turns. The divergence between analyst optimism and major investor actions is unsettling. It creates a sense of uncertainty, as investors weigh expert forecasts against the real-world decisions of those with the most at stake. Investors are left to decide, trust the forecasts or follow the money out the door. In moments like these, the market's next move is anything but certain, and every investor must choose their own path forward. While tech dominates headlines, Japan's weakening yen is another source of global instability. The yen has slipped past 155 per dollar, a level that previously triggered government intervention. A weak yen helps exports, but raises import costs, fueling domestic inflation. Finance officials have issued warnings, but markets doubt their resolve to act decisively. Policy contradictions, talking up the yen while favoring stimulus and low rates, undermine credibility. The Bank of Japan faces a dilemma: raise rates and risk recovery, or intervene and offer only temporary relief. As the yen weakens, uncertainty grows for businesses and investors. Japan's currency woes add to the global market stress. Japan's government is preparing a massive stimulus package, about 17 trillion yen, to jumpstart its sluggish economy. The plan includes cash handouts, business subsidies, and public works, aiming to break decades of stagnation. But with Japan's debt already sky-high, funding this package means issuing more government bonds. This could push up borrowing costs and raise doubts about fiscal sustainability. The move complicates the yen's situation, as more spending and low rates fuel further depreciation. Investors see a government prioritizing growth over discipline, encouraging capital flight. Prime Minister Takaichi's gamble could revitalize the economy, or trigger a crisis of confidence. The stakes for Japan's future are enormous. Markets aren't waiting for Japan's stimulus to pass judgment. The bond market is already flashing red. Investors are selling Japanese government bonds, driving yields to their highest since 1999. Rising yields signal growing concern about Japan's debt and fiscal trajectory. Higher yields mean more expensive borrowing for the government, businesses, and consumers. This could undermine the very stimulus meant to boost the economy. The Bank of Japan faces a tough choice: cap yields and weaken the yen further, or let them rise and risk choking recovery. The bond market's reaction exposes deep tensions in Japan's economic policy. Anxiety is feeding back into global markets. Japan's fiscal gamble is now a global concern. Amid global turmoil, investors are closely watching the U.S. Federal Reserve. The Fed's interest rate decisions shape financial conditions worldwide. This week, all eyes are on economic data and speeches from key Fed officials for clues about future policy. Strong data could mean higher rates for longer. Weak data might prompt talk of easing. Every word from Fed officials is scrutinized for hints of a shift. The Fed's balancing act, fighting inflation without causing recession, keeps markets on edge. U.S. policy remains the anchor in a sea of uncertainty. Today's market anxiety is driven by a convergence of powerful, interconnected risks. The fate of the AI boom, personified by Nvidia, hangs in the balance as investors question whether the rally is sustainable or a bubble. High-profile exits by major investors and Japan's currency and fiscal challenges add to the uncertainty. Surging bond yields and policy contradictions in Japan are spilling over into global markets. Meanwhile, the Federal Reserve's next move remains a wild card. Investors are navigating multiple storms at once, with caution as their only certainty. The coming days will reveal whether markets can weather this perfect storm.